Hello, everybody. Today we're going to be diving into the realm of stagflation, a phenomenon that challenges conventional economic wisdom. So, what is stagflation? In terms of basic economic theory, when an economy is growing, demand for goods and services will also be rising. This goes hand in hand with other factors as well, such as the employment situation. So, as demand rises, more goods and services will be produced, as well as more workers. This leads to an increase in wages and a decrease in unemployment. This in turn leads to more demand for products and services, which leads to higher prices. And so on, of course. When we're talking about prices for goods and services increasing, we're talking about inflation. So we can expect inflation to be rising when we're going through economic growth. On the other hand, if economic growth is declining, we can expect the opposite to be happening. Prices will be falling as there's less demand. Workers will be laid off, wages will be declining. This leads to even less demand for goods and services, and prices will fall. Therefore, we normally expect inflation to rise when an economy is growing and to fall when an economy is declining. This is in basic economic theory, but in reality, we can also have a strange situation where inflation is rising, but economic growth is not. This is what's known as stagflation, to be specific. A combination of two economic problems is known as stagflation. The first is stagnation, which is when the economy goes through a period of low or negative economic growth. It's said to be in stagnation when the GDP falls below 2 annually. And the second factor is persistent high inflation. This is considered to be high when it's above the central bank's target, which is typically 2% for most major central banks. So, when both of these economic issues are at play at the same time, the economy is experiencing stagflation. You could probably guess that stagflation is bad for the economy, and that policymakers would be desperately trying to avoid it. Low economic growth means that workers won't have a favorable situation at work. Instead, they'll have to deal with rising inflation and rising unemployment, wherein workers demand higher wages to counteract price increases. However, rising wages will also raise inflation, because higher wages necessitate higher prices for goods and services to cover the additional costs. All things considered, this can be a very difficult period for the economy to recover from. A portion of the cause of stagflation during the 1970s can be linked to cost push inflation, which is typically a temporary factor driving underlying inflation, such as the sudden rise in oil prices or other commodities. There were factors involved as well, such as workers demanding higher wages, which created the wage price spiral, to the point where wage inflation nearly hit 30% in the UK during 1975. Stagflation has occurred in a number of economies, with the most notable period occurring during the 1970s. In fact, this is where the term stagflation originated. So let's take a look at what actions policymakers can take. As we've been hearing from central bankers a lot recently, monetary policy isn't really designed to solve issues on the supply side. Any sort of supply side shocks, so that makes it difficult for central banks to try to fix the issue. On one hand, what central banks can do is tighten their monetary policy, if they're doing something like quantitative easing. This can be an issue if it isn't leading to economic growth, as the extra liquidity in the economy will be leading to inflation. However, when they tighten monetary policy in a situation when the economy isn't experiencing growth, they run the risk of pushing the economy into a recession, as it would still reduce the total demand for goods and services in the economy, known as aggregate demand. On the other hand, central banks would also want to maintain maximum employment, and to achieve that, they may want to loosen monetary policy in an attempt to support economic growth. As that could also increase aggregate demand, the big problem is that they can't do both actions at the same time. So there will need to be a trade off between price stability and maximum employment, which is why they'd be keen to avoiding getting into this situation in the first place, because they're in a catch 22. This is probably one of the reasons why many major central banks are delaying tightening policy too soon, because doing so could hurt economic growth and the labor market. Instead, by keeping interest rates low and accepting some temporary cost push inflation, central banks are essentially saying that doing so is less risky and undermining economic growth. And that's how stagflation works, guys. Thanks for watching.